Hello again, everyone, and welcome to our last installment of a 4 video series here on the Students in Money Management at St. Bonaventure University's Portfolio Analytics. I'm your host, James Tantello, and I'll be going through our realized gains spreadsheet. This spreadsheet was created last year by yours truly. We were really looking for a performance base on stocks that we had sold. So we talked earlier about how when you have unrealized gains and losses, those are on current holdings. But when you decide to sell a security, you are now realizing those gains and losses. So we said, while we take those out of our portfolio analytics, our diversification spreadsheets, and they're no longer part of our current holdings, we want to take a look at how they're doing, how they're performing in the market after we sell them, and see if our investment thesis to sell those stocks was the correct decision. And this is all on this one spreadsheet. So I'll talk about how we go about getting that information and providing analysis for that, and then also as we move along here, how the current market performance also affects our realized gains analysis. So what you see in front of you is it's a lot of, here I'll zoom in for you guys, is a bunch of different stocks that we've sold, ETFs included, over the years, starting February of 2012 when this was created, all the way through now. And every month this gets updated just like the benchmark does, just like our analytics and our diversification does. So some of the things we have across the top, we've got our normal ticker. We talked about this in portfolio analytics, how this is the 3-letter or 4-letter or 2-letter name that the companies take on when they're sold in the market. So they don't have to say PowerShares NASDAQ, they can say QQQ when they're ordering and buying and selling stocks. We've got what sector it is, and then we've got purchase date and sale date. These are all pretty self-explanatory. Time held, this was our Students in Money Management's founder, Chris Kinslow, was interested in the average amount of years that we were holding some of our stocks. So this is a calculation that at the bottom here gets us to the average years held for securities that we're selling. And so for our entire portfolio, our average years are 2.17%, which is not bad at all. I actually consider that metric pretty good. Our fourth one in this group here is years since sale, and this is how many years have gone by since we've sold the product, what we sold it at, how many shares we sold, and what the value was at that sale date. After that, it gets into what the current value is based on the market price and whether or not we had a gain or loss. So if you remember, on our portfolio analytics spreadsheet, we had a cost basis and a market value. In the same way that we have that, we have basically a sale basis. So what was our basis in the stock when we sold it to what the current market basis would be. And that's what you get here. So you take your number of shares that you sold, multiply it by your market price, and you've got your current value. You take the shares that you sold, multiply it by your market price when you sold it, and you have your value at your sale date. The discrepancy between the two, the current value and the market value, is what you would consider to be your gain or loss. So we see up here in this formula bar, we've got our losses is our current value minus our value at sale date, or if you're in the portfolio analytics, your market value minus your cost basis, if that helps you to understand that a little bit better. Just like the analytics, we make sure we have it in a percentage gain for the amount of time that we've sold it, and then we also annualize that so that the stocks that we've sold more than a year ago and the stocks that we've sold within a year are all on comparable terms. Now the colors here represent different things. So the green means that the company has appreciated in value, which means the stock price has gone up since we sold it, and red means that it has gone down in value, meaning that the stock price has lowered over the years. So we have a pretty good group of these as we go by, and you go to the top here and you say, you have all this green, so why didn't you just keep all of these companies? And I would say to you that the market gets back about 8 to 12% a year. So if companies aren't earning that 8 to 12% average over the course of the years, then it would be better to own the market. And when we sell a security, that's considered an investment in the market. So when we have this annualized return, we're going to compare that to the S&P 500, how the market performs. And that's done over here in this section. So I'll quickly recap what happened here and all the things down at the bottom. So here's our subtotals. So this subtotal here is going to be the total value of our entire portfolio if it was a combination of everything that we sold on the date that it was sold. And this value here is our market value. So this is every stock in this spreadsheet, the shares times the current market price all added together. And then obviously we've got a gain of 22.58% overall. Again, that's not annualized. So if we were to annualize that, oh boy, that would be a completely different number. So now we're over here in the S&P. So what we did in order to compare our individual securities returns to the S&P 500 is we took the S&P 500 value at the date of sale. So the closing price, or the price at 4 p.m. on the day that we sold it. Because remember, the market's open from 9:30 a.m. to 4 p.m. for our normal securities and equities. And we also have the current market price. And we're doing the same thing with the S&P that we did with our securities over to the left here. We have the value at sale and the market value, and then we have a gain or a loss since that sale, percentaged and annualized. And when you take the difference between the S&P's annualized return and each of our securities annualized returns, then we get a better picture of what the relative gain and loss would be for each of our securities. So where it's all green over here in column P for our annualized returns, now our relative gain and loss, there's a lot more red involved, and that's because the S&P has done much better, or even a little bit better than these securities have over the same time period. So we're looking at, if these are all red, then that means that we have a good investment thesis, that we've done our job, and that sale is actually would have given us, if we didn't sell it, we would have made less money going forward. All the greens are scenarios where we would have made more money if we held onto the stock. The biggest example is Netflix. We sold Netflix back when it was $66.90 a share, and right after that happened, it blew up. And it reached almost $400 a share. Now it's down to $346.57, but still, that's almost $300 more than it was when we sold it. So that's constantly going to be a bigger gain than it's still 96.46% higher than even if you net it out with the Standard & Poor's relative gain. So, like I said before, this is a spreadsheet that we've created to track our gains and losses on securities that we've sold, and this is a pretty beneficial spreadsheet, and something that you guys should be able to understand more or less, and be able to, when you're reading through this, understand the metrics that we're going at here. And like I said, the big one is the average number of years, and I think one of the things that we can implement going forward is we've got percentage of portfolio. I did miss this column. So the percentage of the portfolio column is a column that says, out of our basically made up portfolio here, valued at around $250,000 right now at a current market price, what is our percentage for each of our stocks? And what I can do is I can weight our average years based on that percentage. So that'll be some things going forward that we can do to make the spreadsheet better. And I guess in closing, to kind of group in all 4 videos into one, they all work in tandem. So the portfolio analytics feeds into the diversification, which feeds into the benchmark. And the portfolio analytics, when we sell things, that feeds into our realized gains tab. So our realized gains tab on the portfolio analytics spreadsheet, but also our realized gains spreadsheet that's in front of you right now. So the big thing to know is that they all work in tandem. You're not looking at 4 different spreadsheets that are all independent from each other and autonomous, but rather they work together. And when they all work together and you understand the complete picture, then you have a pretty great idea of what the head of analytics is going to be doing on a day-to-day and a month-to-month basis. So thanks for your time over the past 4 videos, and I hope that you've learned something. And for the younger people who are in sim, I wish you the best of luck in whatever you decide to do for sim. It can only be as good as our members. So I guess I just strive to learn as much as you can to make sim a better operated organization, and overall to make sure we're still earning money. So this is James signing off for the last time, and we'll hopefully talk to you guys soon. Take it easy.